Hi, guys. I am going live, hopefully, right now. I'm going to check on my phone, but I should be live right now in my Facebook group, The Profit Factor, and I should also be live on my YouTube channel. So let's take a look and make sure. Oh, it looks like I have one person on so far. So let me check my audio.
Going live.
Yep. We're jumping up to 4. So I think you guys should all be able to hear me. I can hear myself on my phone. And let's make sure that this is also going live over on YouTube, which it should be. Oh, yeah. And it looks like people are hopping on. So if you guys are here, just say hi. Let me know if you can hear me. I think that this is going to be a popular topic. You are in love with YouTube. I don't know if I'm in love with it yet. I'm definitely in like once I learned that you could monetize it. So I have to learn more about that. But right now it's kind of been challenging because I'm trying to figure out basically like a brand new language. I don't really know what I'm doing on the back end, but hopefully it is streaming there right now. Okay, so remember, guys, I am using StreamYard, which means if you don't grant it permission, I actually can't tell who you are. So that one just says Facebook user. So let me see if Sky. Hi, Deetra. Hi, Sky. Okay, so I'll keep my phone there so I can see what's going on there. So we have it's only 1:02, so I'll give people a couple minutes to hop in. But I know that we have had, I think, like over 40 new members in the past week. So I just want to briefly explain who I am in case you are new here. So I am Danae Wolf. So I am a virtual CFO. So a lot of times I get asked, what exactly does that mean? So I am a financial clarity coach and a profit strategist. So everything I do is to help entrepreneurs understand their numbers so that you can actually take that information, take that data, and make operational improvements in your business that help increase your profit. So I'm sort of like a profit coach. My whole goal is to make sure that you are making as much money as possible. And I really believe that if you don't know what's going on in your bank account, you don't know what's going on in your business. So I think that just being enlightened as to where your money is coming and going from, you can get so much information from just that data, and you can really utilize it to make changes that are going to help you make more money. So that's what I do. Most recently here, we have had to majorly pivot to talk about all things COVID stimulus, because that was really the best way for me to be able to bring you guys value. That's what everybody needed. So we've been really heavy talking about EIDL loans and grants and the PPP and PUA, which is the unemployment for the self-employed. So that's really been the main focus. But today is sort of us dipping our toe back into our regularly scheduled program. This is the kind of stuff that I was doing pre-COVID. So one of the major things that comes up, and I'm not exaggerating when I say on a weekly basis, when I'm on my consult calls or when you guys are sending me private messages, the topic I am most regularly asked about is S Corps. It's a very, very common thing. And what I find about at least 90% of the time, again, not an exaggeration, at least 90% of the time, is that most of the entrepreneurs I talk to who are S Corps are actually not operating within compliance of the S Corp regulations. So I wanted to be able to hop on today because I really want to dive deep into what exactly is an S Corp. So first, I just want to make sure I give you guys a disclaimer, like, I'm not a lawyer and I'm not your CPA, right? So you always want to make sure that any advice specific to you and custom to your specific situation, talk to your lawyer, talk to your CPA. This is just for educational purposes only, and me just telling you the rules and regulations of how this stuff works. Don't misconstrue this to be legal or tax advice. So just hashtag disclaimer, just throwing that out there, okay? So it is 1:05. It looks like we have 15 people on. I think there was probably like 25 or so that said they were going to come, but hopefully they'll be able to hop on in a bit. But I think that hey, Christine, hi, Mike. I think that we are, hey, Jess, going to be able to get started here. So let's pop in. Okay, so the first thing that I really want to dive into, is what is an S Corp? So I think that one of the things that most people don't realize, because I hear a lot. Sorry, I was looking at my phone. I thought somebody was asking a question. I hear a lot this term, I'm an S Corp. I'm an S Corp. So I want to make sure we kind of clarify. S Corp is not a business entity. Okay, so when we're talking about a business entity, we have an LLC as an option, right? And then we have a C Corp as an option, which a C Corp is a whole other beast, and that'll be a training for another day. But hey, Jen, but as an S Corp, what you actually are doing is you're making an S Corp election. So you're not actually forming a business entity. You are not an S Corp. You are either an LLC or you are a C Corp that is electing to be taxed as an S Corp. So that's the first kind of basic piece of knowledge to just understand, that an S Corp is simply a tax election. It is not a business entity. So you are not an S Corp. You are either an LLC or a C Corp that has elected to be taxed as an S corporation. That's sort of the first thing that I wanted to make sure I clarify. You guys just understand the difference of that. Now, what I know is very common that I think most of you are aware of and most of you have heard is there are tax incentives to being an S Corp, which is true. And we're going to get into that and how that works. But that seems to be the very popular piece of information that's floating out there. Everybody knows that you can save money on your taxes if you are an S Corp, which means you've elected to be taxed as an S Corp. So in making this election, yes, there's going to be tax incentives. There are going to be tax breaks and perks, which we are definitely going to talk about. But there are also requirements. And a lot of times, what I'm seeing, like at least 90% of the time, entrepreneurs are not following the requirements of an S Corp. So the first one that I want to discuss is a reasonable salary. So if you have elected to be taxed as an S Corp, it is mandatory that you take a reasonable salary. Okay, that is how the IRS outlines it. They just use the term reasonable. So how do we define reasonable? What exactly does reasonable mean? So there's two things that you guys want to make sure that you are looking at when you are determining whether or not your salary is reasonable. So the first part is you want to ask yourself one simple question. If I were to hire someone to do the work that I do for my business, how much would I have to pay them? So you're going to want to maybe look around on a website such as Glassdoor, right? Which that website will be able to provide you average salaries and pay rates for different types of jobs. So you want to take a look at the actual job you do in your business, because this reasonable salary that an S Corp election mandates you take is specifically to compensate you for work you do in your business. So if you own a cleaning company and you actually clean the houses, right? That's going to be a very different wage than, let's say you own a cleaning company and you only do admin for your company, right? So obviously our cleaners who are out in the field, who are typically going to get a commission cut, they're going to get paid much higher than our admin. So you have to take those kind of things into consideration. So you're going to say, what is the work that I actually do for my business? And if I were to hire someone to do this, what would be a reasonable salary that I would pay this individual? The second part that you have to take a look at when you're trying to determine what would be considered a reasonable salary is you want to take a look at the split. So what do I mean by the split? So when you elect to be taxed as an S Corp, your income is going to be split into two buckets, okay? And we will get into more of that as we go on here. But in regards to the split, when we split our income, we're taking part of it in a draw and we're taking part of it in a reasonable salary, right? And stick with me here because we're going to get into the second part later. But when we look at that split, it needs to be reasonable. So what do I mean by that? We don't want to see a situation where you took a 90% draw and a 10% salary. Okay. We want that to be more evenly distributed because it does cause a red flag with the IRS and it's going to increase your chances for being audited. So again, we're looking at two things. How much would it cost me to hire someone to do the work I do in my business? And is my split reasonable? When I am splitting what I'm taking in draw and what I am taking in salary, is this a reasonable amount? So again, something that is a 90-10 split isn't going to make the most sense. So step one, how much would you pay someone to do the work that you do? And I gave the example of if you're a cleaning company, are you doing admin work or are you doing cleaning work? Those are two entirely different wage rates, right? And then is your percentage split reasonable? When we look at our two buckets of income, we have our salary and we have our draw. Is it a 90-10 split? Is it a 50-50 split? You want to pay attention to that. The second requirement outside of the mandate that you pay yourself this reasonable salary is that you file an 1120S. So what the heck is an 1120S? So it is a tax return for your business. So when we are an LLC, we file one tax return. It's our personal tax return. When you elect to be taxed as an S Corp, you actually have two tax returns. So you're going to have a tax return for the business, which is the 1120S, and then you will still be responsible for filing your personal tax return. Now, one thing to keep in mind is this 1120S is actually due an entire month earlier than your personal. So you want to keep that deadline in mind. This 1120S is due March 15th. And as we all know, I hope we all know, taxes are due April 15th. Now, obviously, this year was a little bit different because of COVID, but we should be back to normal next year. So typically, we're going to file our personal on April 15th. So our 1120S is going to be due an entire month in advance. Those of you who do not keep up with your finances, which means your bookkeeping is severely behind and everything is a mess, you might be typically down to the wire, right, with getting your taxes done. It might be April 10th and you're like, crap, I still don't have my stuff together. You're now going to be expected to have it together even sooner. So keep this in mind. Keep this in mind as you're trying to make this decision whether or not an S Corp election makes the most sense for you. Now, the reason that your taxes for your business must be filed a month in advance is because your 1120S will provide you with a K1. You need a K1 in order to file your personal tax return, which is called the 1040. There's all kinds of numbers, letters. It is what it is. It looks like there is an error loading that I'm seeing on my phone. Can anybody else tell me, are you guys having that issue or can everybody see me? I have my phone running on the side just so I can make sure that I can see people's names. And I just looked over and saw that there was an error. Can someone just tell me if you guys have been able to hear me and see me the whole time, or do I need to go back and recap anything? If anybody can let me know, did it cut out on you guys or was it just on my phone that it cut out? Okay. So Jen, I hope when you say no, that means it did not cut out. Okay. So you are going to file the 1120S and it will give you a K1, which is how you will report the money that you made from your business onto your, all is good, thanks Jess, onto your personal taxes. So that is why we have to make sure that we file it in advance. But Thanks, Karen. I appreciate it. It must have just been my phone. Technology does not work in my house. I don't know what the situation is here. So this is something that you want to make sure that you consider, right? Are your books up to date? Is everything organized? Are you going to have your life together and ready to roll for a deadline of March 15th? So if you historically don't have your stuff together by April 15th, you might want to think about this, right? Because it's going to be due March 15th. Now, I want to point out, you don't need to pay anything March 15th, okay? So it's not that I'm saying you have to file and pay your taxes a month early. You have to file this 1120S, which will generate a K1, which tells us how much money you made from your business, which we then report on your personal tax return. And that is how they'll determine how much money you owe in taxes. Okay, so don't worry about anything that you would owe a month in advance, because that's not the situation. So again, to recap, those of you who might be joining us late, an S Corp is not a business entity. It is a tax election. So you would be an LLC or a C Corp electing to be taxed as an S Corp. As an S Corp, there are certain requirements. The two biggest ones would be, you must take a portion of your pay as a reasonable salary. In order to determine your reasonable salary, you're going to want to ask yourself, how much would I pay someone to do the job that I do in my business? You're also going to want to take a look at the split. You're going to take your pay as a salary and you're going to take your pay as a draw. What's that split? Are you coming in at a 90-10, which would be pretty unreasonable? Or is it closer to a 50-50, which is going to be more reasonable? It's going to make more sense. The other thing to know is you do need to file an 1120S tax return that is due March 15th, in addition to filing your personal tax return, the 1040, which is due April 15th. So we now have 2 tax returns. So it seems like those are some pretty serious requirements, right? For a lot of us, we're going to have to change the way that we do business. So why is it so popular? Well, the reason is because you get a tax perk, right? And I think we've all heard of this. You pay less in taxes as an S Corp. Now, what I find is that most people don't really know how that kind of all breaks down, right? So let's walk through this. So when you elect to be taxed as an S Corp, you are able to split your income into 2 buckets. Okay. So the first thing to note is that I can see you get, thanks, Mina. The first thing to note is that the way this is going to work is we are going to look at your net income, AKA your profit. So let's walk through a very quick scenario here in regards to a profit and loss statement. We have our revenue at the top. Let's say it's $100,000. We have all of our expenses. Let's say that's $50,000. We now have a net income, AKA profit, of $50,000. When you are an LLC, that $50,000, that profit, is what you owe taxes on. Your taxes are split into 2 categories. The first is income tax. Income tax is a rate that varies, right? So this is something that you can go to irs.gov and literally look up what are the 2020 income tax rates. So these are the rates that go based on how much money you make. So I think there's like 5 or 6 tiers. So it might be, 0 to 10,000, your tax rate is 15%. So don't quote me on these. I don't know the numbers, but you can go to irs.gov and see what it is. It typically varies each year. But your income tax rate is a rate specific to how much money you make. The second part of your taxes that you pay is a payroll tax. A payroll tax is 15.3%. That's not going to be based on how much money you make, like the income taxes. However, I'm just going to throw out a quick caveat here. We're not going to go too much down this rabbit hole. I just want to at least throw it out there. At that 15.3% payroll tax, there are some phase outs that happen. So once you hit a certain amount of income, I think it's Medicare, or something drops off. So the percentage drops off a little bit. So there are some caveats there, but for the most part, you're going to have your income tax, which is based on your income, and then a flat rate of 15.3% due on payroll taxes. And as an LLC, you pay that on your entire profit amount. If you elect to be taxed as an S Corp, we're going to run through that same scenario, right? So we now have $100,000 in our revenue. We have $50,000 of expenses, and we have a $50,000 profit. Well, what an S Corp does is allow us to split that income. And we can take a portion as a reasonable salary. Now, this reasonable salary must be paid as payroll. So what do I mean by that? I specifically mean W-2 wages, which means you have hired a professional payroll company to process this payroll for you. And I cannot say enough good things about Gusto. So just a quick side note there. If you are in the market for a payroll company, Gusto is amazing. But you will want to hire a professional payroll company to process this payroll for you. You will need to make sure that they are processing, filing and paying your payroll taxes each time you get paid, which means they're withholding your payroll taxes. So this reasonable salary that you have to make must be done through a payroll company and must be have the taxes withheld. Those taxes that are withheld are your income tax and your payroll tax, that 15.3%. So now we have the second part, and sorry, I keep looking at my phone just to see if anybody's asking questions. Now we have the second part of our income, right? So we had our profit of $50,000. We're allowed to take a portion of it and pay ourselves a reasonable salary. What is left over, we take as a draw or an owner's distribution. I'm sure you guys have heard these terms. This remaining piece is where the tax break comes into play. So what happens is on this part, you do not need to pay the payroll tax, which is at 15.3%. You only have to pay the income tax. So why is this? Why does the IRS give us this tax break here? Well, the reasonable salary that you pay payroll taxes on is compensation you are receiving for actually working in your business. So this means you are playing an active role in the day-to-day operations. That's why we ask ourselves the question of, how much would I have to pay someone to do the work that I do? Because in theory, you are fulfilling a role in your business that, could you not do it anymore, you'd have to hire someone to do it. When you're talking about the compensation you receive in a draw or in a distribution, and let's break that down as well, because I explained that the reasonable salary must be paid through payroll, W-2 wages, with taxes being withheld. So when I say draw or owner's distribution, what I specifically mean is this is what you pay yourself in. We could do it in two ways. We could literally write ourselves a check, right out of our business checking account, which is a little antiquated, a little old fashioned, kind of a pain in your ass, right? Because now we have to deposit said check. The other thing we could do is make sure that our business checking account is connected to our personal checking account online, and we're just going to do a transfer, make your life really easy. But that's what happens when you pay yourself in a draw. So it's not issued through the payroll company. You either write yourself a check or make that transfer and give yourself that money. Now, that distribution that you're taking is not compensation for work that you actually performed in your business. So this is considered investment income. So this is essentially you saying, I am an investor in my business and I'm getting a return on my investment. This is my ROI. This is my dividend, so to speak, how I am paying myself off of this investment. So because it's not for work performed as an employee. It's not payroll. Therefore, you don't have to pay payroll tax. So that's how you receive the tax break on the S Corp. But, okay, because I'm sure there's so many of you going, oh my gosh, I'm going to save 15%. I need to be an S Corp right now. We need to go back and look at these compliance issues, and then we need to go back and say, what kind of implications do the compliance issues have? Okay, so, and let me just make sure we don't have any questions. Nope, don't see any questions. So, first of all, when we are saying reasonable salary, right? So again, we're talking, what do we have to hire someone? So in the scenario I just gave, it was $50,000 of net income, right? AKA $50,000 of profit. So how much would you have to pay someone to replace you? What is a reasonable salary? You're not going to be able to get away with $10,000, right? And even if you did, that's not a fair enough split. So let's say we look, because remember, we're looking reasonable wages, two things. How much could you pay someone, and is the split reasonable? So let's say we go with a 50-50 split, right? Because 50-50 can always be considered reasonable, one would think, right? 90-10, you're pushing it, 80-20, but 50-50, most people aren't going to argue with that. So that's one requirement fulfilled. But now let's look at the reasonableness of the salary. That's a $25,000 salary. Is that reasonable? You're going to want to break down those hours. You're going to want to see what that hourly rate is and see, does that make sense? If you get audited, is the IRS going to believe that someone would be willing to take that job for $25,000 a year? So in that scenario that I just laid out, that might be a tough sell, right? Proving that you could hire someone for $25,000 to do the work. Now, you also, again, want to know, what exactly do you do in your business, right? Maybe you're like, hey, I work very part-time. I can prove that I don't work a lot of hours. I can prove that this would be a rate that I would pay someone else. I can back up that, $25,000 makes sense. So now we want to look at that second piece, right? The second piece is that you have to have that 1120S filed, and you have to pay that said salary, that reasonable salary, through a payroll company. So now we get into these extra fees, right? So do these numbers actually make sense? When we look at our savings, our tax savings, we now have to say, well, I have to pay for a second tax return. So not only are you filing your personal, you're now spending out of pocket to get a second tax return done. You now are incurring the costs of you being on payroll. You are an employee of your company. So in most states and cases, you will also need to be on workers' comp and unemployment insurance. So once you take a look at, I now have the cost of 2 tax returns. I now have the cost of hiring a payroll company to process my payroll. I have an extra person on workers' comp. I have an extra person on unemployment insurance. If your state mandates this, you have to actually look at those costs. So what I strongly recommend, whoever your tax preparer is, I want you to ask them to run a side-by-side comparison. I'm going to share my screen with you and give you an example of a real life side-by-side comparison, okay? So again, this is something that is, you need to, there's not a magic calculator for this, right? Everybody's tax situation is very different. Every state's going to be different. Everybody's income tax rate is different. But I just want to show you a real life scenario of one of my clients. Obviously, I've changed her name on here, but I will say she was based in New Jersey. So obviously, each state has different tax rates. But I just want to show you her specific example. So let's see here if I can share my screen. Okay, so in this particular client, what we did is we ran, well, I didn't do it. her tax preparer did. This is quite complicated to do. So this is column here is if she were taxed as an LLC. Column here is if she agreed to be elected to be taxed as an S Corp. Her net income. Okay, so I want to be really clear with this part of it. Her net income, her profit on her business was $180,782. So that's how much profit we were dealing with. Now, when we ran through the scenario and broke everything down, the different ways that an S Corp would be taxed compared to an LLC, her tax savings was $3,018.39. Okay, that's what it broke down to. But we now have to pay for an 1120S. She was charged $650 for that. She had to set up payroll. That was $100 a month for her in her situation. That was an extra $1,200 for the year. Now, if her books were not clean, right? If your books are not up to date, when you go to file that 1120S, you also have the fees of cleaning up the books, right? Which is also going to make that higher. So when we deduct her $1,200 for her payroll fees, we deduct the $650 for that tax filing, we're cutting that tax savings in half. Now, this is also a very successful business. She had a profit of almost $181,000, and her net savings, because we have to look at what was her tax savings and then what were the fees associated, was only about $1,500 to $2,000. That was at $181,000 in profit. Okay, and this is a real life scenario, guys. So you want your tax preparer to run these numbers. My recommendation and the typical rule of thumb is if your profit is about $55,000, $65,000 a year, in that range, you should be asking your tax preparer to run this scenario. If your tax preparer is telling you to be taxed as an S Corp because it gives a tax break, and they are not offering to run the scenario and show the difference, you need to be wary, because what I have found, and a lot, okay, I see this every single tax season. The reason a tax preparer is pushing a client to be taxed as an S Corp is because they now make more money because they are filing a second tax return. They get to file your 1040 and they get to file your 1120S, which means they've now doubled how much money they're making off of you. You want to make sure that they have run this number. So if you are in a $50,000, $60,000 range of net profit, I want you to say to your tax preparer, run both scenarios. Provide me with a side-by-side comparison. And I want you to be very weary of any tax preparer who is unwilling to do this. And I see some comments here. Hold on. Mark. Hi, Mark. I've been building my business for the last 3 years. I've been eating beans and rice, trying to succeed, pouring all my income back into it while living on $15,000 a year. I can't get PPP because I didn't make enough money. I have an S Corp and are paying myself draws. No. So, Mark, you would not be compliant, and we are going to get to that. And somebody just said, this is for an S Corp, correct? Sorry, I came on late. Yep, this whole training is on S Corps. This whole training is on S Corps. So, again, the tax savings is offset by fees. I just showed you a real life example. It was a New Jersey resident. So again, states are a little bit different on how they're taxed, but high level, it was $181,000 in profit. Her net savings was only about around $2,000, $1,800, something like that. So if you are in a $40,000, I'm seeing $30,000, $20,000 net profits electing as S Corps. Again, I can't provide you with a standard calculator or anything. There's too many different factors that go into your taxes. But what I can tell you is do not elect to be taxed as an S Corp unless you have seen a side-by-side comparison. That is what you want your tax preparer to do. Now, the other thing I want to point out, there is a QBI. This is a qualified business income deduction. This is something that was created under Trump's tax cuts and is set to expire in 2025. But for now, it is alive and well. So a lot of you may be thinking, well, if I have an LLC and I have to pay income tax and self-employment taxes on my entire profit, and as an S Corp, I only have to pay it on a percentage of profit, it's a no-brainer. Well, I want to tell you about the QBI because it's making these scenarios for S Corps, the side-by-side comparisons, not as appealing. So the QBI, again, has a lot of different caveats to it, and there's different things you're going to want to talk to with your tax provider. But the general sort of rule, you're going to get a 20% deduction. Okay. So remember, the savings on the S Corp is the payroll taxes, which is 15.3% on your portion of your draw. There is also this QBI deduction that is 20% that as an LLC, you are going to get on your entire profit. Okay. Now for an S Corp, you can also get the QBI, but it's only going to be on that net income number after that salary has been paid out, right? So that on that remaining balance. That extra 20% really comes into play and changes this scenario of the LLC S Corp comparison, right? It throws a different thing in there that really is not making the S Corp as advantageous as it once was. So just something to point out there and make sure that you guys are aware of. But when you're hearing me say, there's a 15.3%, there's a 20%, you guys can see how complicated and complex this tends to get, which is why I want to make sure that if you are to anyone who's a business owner, I think you should hire someone to do your taxes. But specifically, if you are electing to be an S Corp, I want you to make the investment on a good tax preparer. Like I think it's completely necessary is a good use of funds. So just wanted to throw that out there about the 20% deduction, just so that you guys know, this scenario does get more complex. Like, yes, as the LLC, you would be paying that 15.3% on your full net income, but you also get 20% deduction on the full net income. So again, you have to take the time to run the numbers. The other thing I want to point out about the S Corp, and hold on, I'm seeing some comments. So okay, so this just says Facebook user. So let me see. So this is Rosie. What might be the implication? Oh, you know what? I can do this, which is going to make everybody's life easier. You guys can see it. Okay. What might be the implications of someone not being in compliance with the S Corp, aka not paying themselves a reasonable salary? Client did not do this for the first 2 years of electing. Yeah, we're going to get into that stuff and making sure that you guys are compliant. And here's another question. Danae, we are set up as a C Corp. We were told by a business broker we would be taxed at 43% on total sale of the business. Should we be looking to set up an LLC or S Corp? Your thoughts? Thank you. So C Corp is a totally different beast, which we can do a training on at another time. But high level with the C Corp, it's double taxation. So a C Corp is really for someone who is looking to keep money in the business because you're not going to be taxed on things that you leave in the business for your normal income tax rates. You're going to be taxed a low corporate rate. So it's very advantageous for a very specific type of entrepreneur. Most people here, an S Corp LLC situation is going to make way more sense. But so let's hop into, because somebody had asked the question about, what can kind of happen. But before we do that, I want to point out another requirement with the S Corp. And I'm just going to be honest, this one, it gets kind of deep. Like I'm legit going to open my notes because I want to make sure that you guys understand that this is important and that you should be having a professional calculate this and figure it out. Okay. So I don't think that you guys need to 100% understand how basis works, but you need to make sure that you have hired a professional who is handling it for you. So another caveat to throw out there about an S Corp is that you do have to maintain basis in your business. So what basis is essentially what is your net investment in your business. Okay. So with basis, they are looking at how much did you put into your business? So let me give you an example. You put in $50,000 to start your business. So we're starting with that as our basis. We have a $50,000 basis in our business. But then you have to add in your share of that net profit, right? Any profit that the business makes, or you would be adding in the loss, right? Maybe the business had a $10,000 loss year one or something like that. So you are going to add in your profit, which would increase basis, or add in your loss, which would obviously decrease your basis. And now I need to reference my notes because I want to make sure I don't mess up the equation for you guys. But this is basically going to show you your money that has come in plus your income minus any losses minus any distributions that you paid out yourself. Okay. So this is going to give you what that basis is, which you want to have a professional calculate. Okay. You want to have a professional calculate it for you. Once you have your basis, it determines your taxability. So let's say you are electing to be taxed as an S Corp and you had a loss in your business. So you actually showed a negative amount on your profit and loss, which I can tell you it is a very popular tax strategy amongst the entrepreneurial community to make sure that they show no profit on their P&L because they don't want to have to pay taxes. Just so you guys know where I stand on that, I hate that. I am in business to make money. I'm in business to make as much money as possible. So I would never want my profit and loss to show a loss and show that I wasn't profitable. I do not want to look poor on paper because if you want to buy a house, if you want to buy a car, if you want to do anything, and a lot of you guys are experiencing this now, just trying to get the EIDL loan, right? Or trying to qualify for PPP. If you're constantly making sure that you show no profit so that you can avoid paying taxes, number one, that's tax evasion. But number two, there's real consequences there. But if you are an LLC who shows a loss on your profit and loss, you could be eligible for a tax return. If you are electing to be taxed as an S Corp and you show a loss, you have to have basis in order to access that loss and get a tax return. So let me kind of explain what that is. If you had a loss of 10 grand, but they look at your basis and they see that you yourself never contributed 10 grand. Maybe you have a very basic business that costs you $500 to start. When you go to claim that loss, you can't take that full loss because you don't have basis. You didn't put that money in to be able to write it off. Whereas with an LLC, it doesn't matter. Now, if you go to sell your business, basis is also going to come into play. They're going to see how much basis you have, and it's going to be deducted from that taxable portion of the gain that you made on the sale. So again, it is a rabbit hole. It is very in-depth. It is not something that we can get into on a Facebook Live. But I want you to at least take away, it is an important number. It affects your taxes, and you want to make sure that you have a professional calculating it and tracking it for you if you are electing to be taxed as an S Corp. Let me get back into these comments here. I see another one. Oh, Mark, you're welcome, Mark. So what can happen if we don't do this? Okay. Well, if we're not following these S Corp, compliance issues, somebody had asked that question. So you get audited. They figure out that you haven't done these things. If you are in a situation where maybe you just didn't take the reasonable salary cut, right? You paid a salary, but it wasn't enough. It wasn't deemed reasonable. You're going to have fines, and you're also going to owe all of the payroll tax that you avoided. Okay. So it's not going to be a good situation. A very popular tax strategy is people try to pay themselves the smallest bit of salary and then a big draw, because the draw is where you save money. Or I see S Corps who come to me who don't pay themselves a salary at all. That is essentially telling the IRS that you don't do anything in your business at all. It is literally an investment. You don't take any calls. You don't talk to anyone. You sit back and collect a check as though it was a stock that you were invested in. That is a giant red flag to the IRS. Okay. Most small businesses are not just sitting back and collecting a check. You're doing something. You're playing some type of a role in your business. Okay. So again, this is going to be a big red flag. If you made $100,000 in profit and you only paid yourself $20,000 in salary, guess what? It's a big red flag. Okay. People get audited for this stuff all the time. So I want to make sure that you guys are informed of this stuff, that you guys are aware of it, and that you really make the right decision for you. So if you think that you can comply with a reasonable salary, you think that you can comply with a reasonable split, I want you to make sure that you have your tax provider run the scenario. Have them send you a spreadsheet. This is what it breaks down to as an LLC. This is what it breaks down to as an S Corp. It is something that will probably take them 10 minutes to do, but you want them to do it because you, again, want to make sure it's not a situation where the tax consultant is saying, oh, well, S Corp save money on taxes. You should do that. Well, they're right. They save money in taxes, but it doesn't mean you should do it. So you want to look at your specific situation and make sure that you're really making the right decision. So I hope that this video was helpful. I hope that I shined some light on some things today. It's definitely one of the most popular questions that I am asked about. And it's definitely one of the biggest mistakes I see happening. I have a lot of clients who come to me who are an S Corp, who are either taking all of their pay and salary and getting zero in tax benefits, yet paying the extra costs. Or I have them coming to me and taking it all in a draw, which is illegal. Or I have them coming to me and their split is just wacky. It's not a reasonable split. So just making sure that you understand these things, that you are compliant, and that you have actually run the numbers. Remember what I always say, numbers don't lie. So we want to run these numbers, and then we want to use the information we get from those numbers to make informed decisions. If you are not making decisions based on what your numbers are telling you, you're probably making the wrong decision. That's what you always want to consult first. So hopefully you guys got a lot of good information today. If you have any questions, you can go ahead and drop them in the comments on the Profit Factor Facebook group. You can also drop comments in YouTube. I don't check that as much. I am very new to YouTube. I have like 2 subscribers. No, I have like 80, but like it's still a joke. We have 1,000 people in the Facebook group and like 2 people on YouTube. So if you guys could head over to YouTube and like and subscribe, I would very much appreciate that. I am trying to grow that following there so that we can help more people. But it was great talking to you guys today, and I hope everybody has a wonderful weekend.